Welcome, welcome. We'll go ahead and get started here in about a minute. For those of you who have attended before, you know we usually do our little very non-technical tech check. So if you can maybe just raise your hand if you can hear me okay and see the screen. So Ryan is sharing his. Excellent. Thank you, thank you, thank you. Good, good. Thank you. About another 30 seconds. Get cranked up. Well, good. I'm going to go ahead and get started. We had a bit of time for some questions on our Tuesday call, but I think less than Ryan and I thought. We had some other materials and good content to go through, which is great. So I am Brian Klontz, president of Charitable Solutions. We're going to be talking today, you can see here, about the top 10 non-cash post-gift considerations and conundrums. So Ryan will be walking us through that, and I'll be chiming in hopefully with some material anecdotes. We will see. It's going to be your call on that. And a couple quick housekeeping notes. As many of you know, we do not send out the slides directly. However, early to mid part of next week, with it being the holiday, we will send out all of the questions and answers from Tuesday's webinar as well as this one. So I'd encourage you to include any questions that you have in the Q&A box, ideally rather than chat, just easier for us to respond to and to scrape post webinar. And then we will pick one of the videos to include as part of our full webinar series. So I think this is, I should know, I think our 35th or 36th one. All are for free, all are on our Charitable Solutions website. So we'll have a little link to that at the end of this presentation today. So with that, I'll really just sort of jump right in, sort of very briefly about sort of us and the firm. So Charitable Solutions just celebrated just our 20th anniversary as of January. Somehow, some way, we have a team of 28 people. Ryan is the managing partner in the non-cash area. We have, I think it's 7 attorneys, including Ryan, as part of the group. And we have a mission since day one in January 15th, 2003. We're formed to help make charitable gifts happen that otherwise wouldn't. And we do that through risk management, both in terms of structure and process. And so we have 6 primary service areas, sort of going top right. So it's probably the least material for this group, but we do emergency assistance fund administration and audits. In particular, in that space, I created a charity in 2010 called the Emergency Assistance Foundation. We have about 175 team members on that side of sort of the shop, if you will. And we primarily manage very large employer groups where they are looking for a charitable fund that can provide relief either because of disasters globally or for personal hardships for their employees. And so you can see there we have about 12 million employees that we now cover as part of those funds. About, I think it's like 380 now funds that we administer there. And you can see there we made over $300 million in grants to employees facing disaster or hardship, in particular for COVID. Interestingly, at least to me, about 60% of those grants are international. So we do this globally. Bottom right, sort of what we're doing today, are a lot of CE type training, whether that's for professional advisors, which is probably about 80% of what we do, either on-site or virtually, or for board, staff, donors, et cetera. The charitable appraisal, sort of bottom middle there, we started, it's growing very quickly, at least percentage-wise. And so our little tagline is, if you can give it to charity, we can appraise it. So we have a team of 5 appraisers. Today, I've had 2 crypto appraisals come in. I'm supposed to do a life insurance appraisal this afternoon. So I do those particular types of assets. But then we have 2 business appraisers, and then 1 that does tangible personal property, artwork, things like that, and then 1 on the precious metal side. So we only do this for charitable donations, whether those are through an estate, but much more practically as outright gifts or life income gifts. So built that out really the last 18 months or so. Gift annuity space really do two things. One is direct consulting for charities that have typically larger pools. So do actuarial stress testing. We have an actuary on staff that she and I work on these particular projects, and basically to see if there are any risks within larger gift annuity pools that can otherwise be mitigated, to ideally, obviously optimize the residuum values within the pools. And more specifically within that, have a particular expertise around very, very large gift annuities. So whether those represent concentrations of risk and or how that risk can be mitigated to the extent that reinsurance is appropriate, sort of at what level, how that should best be designed, placed, and so on. So have done that since inception, probably a little bit more than that, even probably last 24, 25 years in that space. And then what we're talking about a little bit today, first is on the National Gift Annuity Foundation, and that is we have another charity I created that will basically is a giant pool for gift annuities. You can see they're licensed in all 50 states. We have just over 65 million in assets, about 730 contracts. And the key point is that is where a donor is going to a charity and perhaps they're not registered in New York or California or Washington or a particular state, or they don't have a gift annuity program at all, or they don't want to continue issuing gift annuities, or it's for maybe real estate or privately held business interest. Then we are able to issue that gift annuity that otherwise they wouldn't have been comfortable issuing. And then 100% of that residuum is then passed back to that charity or charities that the donor wishes to give to. So doing a lot in that space. That's growing about 15 to 20% a year. And we are doing some Secure 2.0 QCD gift annuities as well. Have a whole webinar on that, which many of you may know, but we were really finding is we've done maybe 3 or 4 of those. It's not a ton, but we're getting a lot of questions about now, what are these gift annuities? And we're a financial advisor. We've never heard about what these are, but we're doing QCDs that our clients love, love, love. And now they're asking us questions about what gift annuities are. So actually we're seeing a nice bump in traditional gift annuity issuance, which we can, of course, for cash or marketable securities too. And finally, non-cash, which is probably about half of all this sort of blob of stuff that we do, at least half, is the non-cash area. So we either provide direct consulting to charities that are doing it themselves, but about probably 95% of our work in this space is through the Decami Foundation and Decami Asset Trust, 2 national donor advised funds I created, one 20 years ago, one about 15 years ago, to receive, where we are obviously the charity, we are in chain of title, we're doing due diligence, basically all risk. We have roughly 20 single member LLCs that we use for some sort of structural risk mitigation, et cetera. But we only receive those gifts that come in from other charities that are not comfortable taking those gifts in. And so instead they refer those to us. We do all, we call it the sausage making. And then once sold, we then make a grant of all the net proceeds less our fee. Our fee is averaged, as you can see there, about 1.4%. Can be much lower on very large gifts and a little bit higher, up to about 2.4% on smaller gifts. But our average gift has been about 4.4 million per donation, and we do about 1 per day. So it's very common. I will say, I think that the topic for next webinar will be sort of on the weird, maybe Ryan would agree with me or not, sort of trends that we're seeing so far this year. Done this a long time. We're doing I shouldn't say much. We're doing about the same number of gifts, if not a touch lower, but these are just gigantic. I mean, just gigantic. So I think we're around the 350, 400 million received already. And Ryan and I are working on at least 3 or 4 gifts that are over sort of that 25 to 90 million, at least that many, frankly, that are all looking to close here in the next 30 days. That's weird. That's really weird. So a lot of activity in this space. The next slide I'll touch on very, very briefly, sort of drills down into that, and that is sort of our 2022 numbers. Main point here is, again, 100% of these gifts were declined initially. I do not include any CRT or CGA activity, of which we are fairly robust around as well. But key point 2 is we only get referrals from other charities. So we're not marketing to donors directly, not marketing to advisors directly. It's only to help them to expand their gift acceptance around particular assets. I just sent Ryan like 30 minutes ago a Bitcoin Cash referral that the charity's like, yeah, we're okay with Bitcoin, okay with Ethereum. We don't want to do anything beyond that. I'm like, okay, then that can potentially come through us. We'll do the processing and then make the grant out. So you can see total donations. By the way, this was down from about 260 donations in 2021. We raised about 1.2 billion in 2021. Only illiquid gifts that other charities had declined. Weirdly, the proportion on real estate and business interest was almost identical. So it was just basically less in 2022, still about 560 million. We are now doing, based on our most recent research, I'm going to put out a white paper here in another 2 weeks or so. We're doing more real estate gifts than any other charity nationally now. So I think it's us and then Nature Conservancy as an example. Strange that we're not doing that many, sort of in that 60 to 80 a year range is pretty typical for us. Main thing is around business interests. So you can see there about $500 million in business interest. It was over $1 billion the year prior. And I will say, I had a great question last time. They said, oh, it's not very many in S Corp. Actually, we're doing a lot in S Corp, but a lot of the LLCs are LLCs, but they're electing to be taxed as S Corp. So weirdly, in 2021 and 2022, if you take all of the S Corp LLCs and you sort of flop them into the S Corp bucket there, it's almost exactly the same number of C Corps, S Corps, and LLCs. It's really, really close. So we do a lot more S Corp because they're taxed as S Corps, even though they're LLCs. So we still do a lot in that space through our UBIT mitigation charity that is a trust form donor advised fund. And then you can see cryptocurrency, cash, et cetera. So what's the point of today? Sort of leading this over to my partner, Ryan. And that is to say, it's great that all these came in, but we also have a bit over $2 billion in assets that we're managing. Weirdly, if everything worked perfectly, we would manage zero. So we are not about sort of building assets over time. If it came in illiquid, it's sold and it's granted out, then we would never have any, theoretically, any assets at all. So a lot of these don't do that. So that's the whole point of today's discussion is post-gift. You pop the champagne, everybody's happy, that's great. And I will say, and Ryan will probably give me an amen here too, in many, many cases, I don't know whether it's the majority or not, sort of all the pre-gift transaction work, if you sort of mush that together in terms of time and effort, and then versus the post-gift, in many cases, the post-gift can be, 70, 80, 90% of all the effort is once the gift is actually completed, because now, in fact, much of the work actually starts. So with that, I'll pass this over to Ryan. Please include any Q&A at the bottom. I'll do my best to answer that as we go. And anything I think that'd be for sort of the good of the group, I'll ask Ryan to answer too. So with that, Ryan.
Great, thanks, Brian. So yeah, like Brian said, talking through a bit of these post-gift considerations, issues, conundrums, problems, whatever you want to call them. So a quick agenda here, pretty simple. A little bit of table setting to start. Then going to look at real estate and business interests. And finally, a quick discussion of what happens when we're talking about a donation of an asset that's located abroad and what the considerations might be that don't exist really for domestic assets that are being donated. And so setting the stage for the rest of the hour here. So you as the charity or maybe as the advisor, you've done all the planning. The donor has agreed that the donation is a good idea. The charity, everyone involved there who needs to approve the donation has approved. You've collected all of the signatures. Everything that needs to be filed has been, and now the gift is officially complete. So is that it? Can you set it and forget it? Move on to the next gift? Well, probably not. And I was thinking about this this morning. Just like with these types of illiquid investments, generally, it's hard to find a turnkey asset. And that applies to the donations of illiquid assets as well. If it's hard to find a turnkey asset that you just buy and it earns you money, why would you expect that for a donated asset of the same type? There's going to be issues that come up. There's going to be planning and maintenance and management that all needs to be done. So what happens after the donation? Well, in most cases, of course, the charity is looking to sell really as quickly as it reasonably can. But the key to that question is when will it be able to sell and how also, because when the charity can sell, well, that determines how long the charity owns the asset, and the problems and issues that can come up, well, they're going to come up during that holding period when you own the asset. But even at sale, there can be some issues. So we're going to talk about that and how the different asset types can make a difference, even within asset classes like real estate and business interests. And Brian has talked about this a little bit with the different types of business interest. There are different considerations that can impact the charity's management of the asset and the sale. And then a final question, and this one comes up from donors. We get this all the time. How involved can I as the donor be once I make the donation? In a lot of ways, that's up to you as the charity, but the donor may have some valuable insights and they may have some ability to assist that maybe you should consider very seriously and think about what kind of advice or recommendations or assistance the donor might be able to provide during the holding period and during the sale process. So those are important considerations. As Brian mentioned, we are going to focus here primarily on real estate and business interests. That's most of what we see. There's a reason that we aren't talking about cryptocurrency at all, because cryptocurrency is very liquid. You don't have this presentation or a version of this presentation for cash, because you as the charity get the cash and then you either spend it or invest it as you normally would. So it's really these illiquid assets where the illiquidity is driving some of these unique considerations post-gift that you wouldn't see with a more liquid donation. So starting with real estate, the obvious one that anyone who has owned or rented a home will know right away, the monthly bills, just because those are in theory simple: utilities, insurance, HOA. Doesn't mean that you as the charity, now the new owner of the real estate, you probably need to get those set up, and you need to find out what they are. And if for some reason you don't need to set them up, you have to know why. Do you not need to set up the electric bill because that's paid by the tenant? Okay, but you've got to think about, okay, does the lease actually call for that, or are you just assuming that the tenant's paying the utilities? Something you have to think through. And it is very important, and it can have serious implications if it's not done, because a frozen pipe, when it thaws, is going to cause damage to the property, and that is going to impact the eventual sale price. Similarly, insurance, if you don't have hazard and liability insurance in play, that could really damage not just the value of the property, that could cost you as the owner money. So you, the charity, could be facing liability if you don't have appropriate insurance in place. So that's an important thing to think about. I've mentioned leases already. That's important as well. A lease is good in some ways because that means you as the owner and as the landlord are getting some income, which you can use to offset the expenses, that billing and taxes, which I'll talk about on the next slide. So it's good to have that income as a buffer, but you have to make sure the lease has been assigned over to you. You need to make sure that the tenant knows where to send their checks. They need to know that there's been a donation. The lease needs to be assigned over or freshly executed. So that all needs to be done. Ideally, you would have that planned out before the donation, but sometimes it just can't happen for whatever reason until the donation's complete. And then you need to do that pretty promptly because a check going to the wrong place is just going to confuse things. And it could be a real problem if the lease is not properly assigned over. Now, you might say, well, there's actually a property management company that handles all of this. That's even better. Now you've got income and you've got a company that handles the leases, the tenants, all the problems that might come up. That's great. You still need to have an agreement with that property management company. So that also needs to be handled. One thing that I would say is if there's not property management, you as the charity need to figure out who's going to be doing the actual on-site management, because there needs to be someone doing that. You could go out and find a new property management company if one is not already in place. That's totally fine. Sometimes donors are willing to do that and willing to do it for free. Usually the best way to do it is have it be done for free if it's going to be the donor. And then the other good candidate for property management is usually the realtor. The realtor has a vested interest, a financial interest in making sure that the property shows well. So they are often able to kind of be checking in on the property and making sure that everything looks good, nothing's gone awry. So a realtor can often help with that. And if it is a bigger firm, they may actually have property management services and have a dedicated team that can help with that. I will say it's unlikely that the charity or someone on the charity's team is going to be doing the property management, just because unless that property is very close to the physical offices of the charity or to that employee's location, it's just not practical. So, you as the charity are going to need to find an outside party to do the property management, and whether that's a property management company, the donor, or the realtor, as long as you've identified someone who can do it and handle things on your behalf, that's very, very helpful. You need to have someone who can pick up the phone and say, hey, look, there's a problem because the AC is not on and it's 100 degrees and humid. So another, and when I mentioned leases, this is probably what came to everyone's mind. What happens if the tenants stop paying rent? That can be a major problem. And I know Brian has a lot of stories here. The issue is you as the charity really do have an obligation to make sure that rent continues to be paid. You have a fiduciary obligation to maintain the value of the asset prior to sale. And if tenants have stopped paying rent, are you willing to evict them? You had better be. That's really the only option. If you've made efforts to collect and they're not paying, then yeah, it has to be an eviction. An eviction can be a very lengthy process depending on the state, and it can be nasty depending on the tenant. So that's something that with income producing real estate, you have to be ready for. Thankfully, most tenants pay rent, but inevitably someone is going to stop. And it's just a matter of the law of averages. So Brian, did you want to add anything to that?
Yeah, I always get to add the not fun thing. So you've already touched on that a little bit. I guess I'll even go up a little bit and I'll hit the rent thing quickly, but I'll add some permutations, because if you do one real estate gift, you've done one real estate gift. Every single one will be different. I wish we could say that there's some kind of systemic or systematized way of doing this that just isn't. So for example, on monthly bills. So many, not all, but many of the types of real estate we get, let's say it's an apartment complex or something, we may not be receiving the whole thing. So there can be an undivided fractional interest. So now we may be a minority or maybe even a majority, but not an entire owner. So what does that mean? Then that means all the utilities need to be split proportionately. There could be issues with insurance being out of state, even if we receive the entire interest in that situation. And so there could be some IRS tax issues. Let's say that if it's, we own 50%, donor owns 50%, but the donor's continuing to pay all the property taxes directly. And we'll just get reimbursed by the charity later. That would not be good optically under an IRS audit, saying, whoa, you gave all this away, but yet you're still paying all of the tax. I mean, so you just want to be real clear that there's been a full irrevocable transfer of whatever that proportional interest is, and that the charity takes that on, which then gets to the charity better have the cash to pay for that, and or requesting that from the donor to front some of that cash. Well, how much cash do you front? 3 months, 6 months, who knows what happens if it doesn't sell in 6 months. So that just gets sort of to the monthly bills. On the insurance that I mentioned, we have some real issues in California, as an example, Where if we're an out-of-state corporation with, let's say, a vacant property, that can be a real problem. We're dealing with one right now, right? And I've been going back and forth. It's like a $9 million property in Palo Alto. And it's like, okay, now what does this mean for insurance? We have a blanket global commercial insurance group contract we use with Marsh. And then so we're able to sort of add, because we do so many of these sort of adding and taking them out. Even then, this is not a huge challenge, but it's taking some effort to get a particular property insured. And somebody on your staff must do that immediately. So this gets back to Ryan's sort of anticipation before it's actually transferred, in that at the extreme, this is a joke, but not really, because this has happened. If you have an apartment complex, somebody will get naked and drunk and jump off of something. I mean, that's just what happens. I have no idea why. So you better be insured for that. And so having that insurance coming over very, very timely is key. People are like, oh, I'm worried about the lawn being cut. That's an issue. I'm worried about insurance and having all that stuff sort of in place, again, to protect the charitable asset. And the final point is, easy for me to say, if you take properties that have a tenant, you better have the stomach to evict. You have to. Because, also a joke, but not really, because this has happened too, whoever you're evicting, to be real clear, that's a lawsuit. You're like, oh, it's an eviction. An eviction is a lawsuit. So you're suing a tenant for lack of payment to protect the charitable asset, which Ryan said you've got a fiduciary obligation to do. The point here is that tenant always, kind of a joke, kind of not, always will be a decorated war veteran. Always. We'll have a very good, and this is horrible, I sound like I'm evil, but we'll have a very good story if a person from the local newspaper calls. So forget legal risk, forget insurance risk. XYZ is evicting this Bronze Star recipient because he's fallen on hard times. Like, yeah, maybe, but he hadn't paid rent for 18 months. That can be a problem. Took us almost 2.5 years to get somebody out of a Syracuse rental property because he very adeptly would time when the eviction would just keep basically delaying over the summer, and then they would evict in the fall, and you're not going to evict in the fall or the winter in Syracuse. So basically just ran that 2 full cycles through. So this is the underbelly of the swamp, unfortunately. Does it happen in all of them? No, but you better be prepared if these things do happen. So pass it back over to you, Ryan.
Yeah, and I mean, even if you don't have a tenant, it's a vacant property, and you've got insurance in place and it's appropriate coverage, you're still looking potentially at a big bill because you have taxes still. And that's county and state. Just because you're a charity doesn't mean that you're exempt from local property taxes. Transfer taxes, sometimes charities are exempt from those, but annual property taxes, probably not. Every state does this differently. So, and this is something I didn't say on Tuesday, but I really should have. If you, the charity, are taking a property that's out of state, do not assume that the property tax rules work the same in that state as they do in yours. That's something that you will want to look into. You'll want to understand when and how property taxes are assessed. If a reassessment was triggered on transfer to a new owner, that happens in California all the time. If there are stamp taxes or transfer taxes that are due, some states have those, some states don't. Wisconsin has them, California does. Some localities, like I think Philadelphia has them, Brian mentioned. Those property taxes are going to need to be paid, and those taxes are probably going to be a big number relative to the other expenses. Probably the biggest in most cases, assuming that you're not dealing with a lawsuit like Brian just mentioned, or some kind of liability that's not covered by insurance. So taxes, very important. And the problem is those bills can be late arriving. So you may have sold the property already and still get a tax bill. You should consider whether some kind of escrow is appropriate to pay any potential taxes, which leads to kind of the final point with real estate, the sale process. In most cases, the charity is getting an outright gift of 100% of the property. which allows them to kind of control the sale process with non-binding advice and recommendations and feedback from the donor. But that still, while that allows you some control over the process, you as the charity still have to understand, okay, who's signing on our behalf, because the title company is going to want to see some sort of authorization for that. And this is a reasonably common request. Sometimes a title company will want to see corporate or board resolutions approving the sale and approving the signer for the specific property to be sold. It's not enough just to have a general signature authority for the signer that gives them authority to sell any and all real estate. The title company will sometimes require, not request, but require a resolution by the board or the trustees or the corporation generally to approve the specific sale and signer. So that's something to keep in mind. And once you've sold, once you're closing all of this out, you've got to cancel the insurance, utilities, everything that you've set up. All those agreements have to be canceled or assigned over to the buyer. But you may want to consider additional escrows, not just for taxes, but for utilities as well, because there can be late arriving utility bills. The good thing is with insurance, you're probably going to get a refund because those policies are paid up front, and you're probably going to be canceling midway through a policy. So you'll get a little bit of money back there. And then one thing I would say, that sale process, you're in total control if you're the sole seller, not the case in a co-sale situation. If your donor retained a portion of their interest, or if you have an unrelated co-seller, the donor only owned half with their brother or sister, and the donor gave their half, but the brother or sister was still an owner, you're going to have to be on the same page as them throughout the sale process. And that can really complicate things as well, especially when it comes to dividing up things like the expenses, the utilities, and insurance on a regular basis. And Brian mentioned that a little bit as well.
And Ryan, do you want to talk about the real fun thing that we're working on in real time in terms of creating issues with the sales process with our fun Ugandan property? Just some interesting perspective.
Yeah, I hit on that very quickly yesterday during the international portion, but the one thing we're dealing with, we've had a property in Uganda for many years. It's very difficult to sell, and we finally got a buyer. The buyer, however, had to pay through installment sale, which we agreed to, and he has made a few payments, which is great. But lo and behold, there were now some squatters on the property. And we found this out, of course, through the grapevine. And thankfully, we had a local attorney. And so we've had to go through not an eviction process because these are squatters, but getting these squatters removed. And it would be impossible to manage without that kind of local assistance. So not property management in sort of the classic sense, but having someone locally who is working on your behalf, an agent in the legal sense for you as the charity, who can represent your interests and can, I mean, you can't make this up, squatters on the property in Africa, very difficult to manage, but thankfully this attorney was able to get them arrested. And now hopefully our buyer will continue with the purchase. I think he has asked to put up a fence to protect what will soon be his property, and we've agreed, and that seemed prudent to everyone involved. So with that, I'm going to move on to business interests. One thing with business interests that is very different from real estate. In most cases with real estate, like I've said, you're getting 100% of the property. And if not, you're probably getting a large portion, and there is, probably only one other owner, maybe 2 or 3 at the most. You can technically have more, but it doesn't happen very often. That's not the case with business interests. You as the charity are extremely unlikely to have majority control, which is probably a good thing. Being the majority owner, whether it's 51% or 100%, comes with some significant responsibilities. Just like with real estate, where you're kind of the sole owner and you have to be responsible for insurance and utilities. However, with business interests, we're talking about a complex organization. There's presumably a lot going on, and now you're in control. So what does that mean? How involved in the day-to-day operations do you as the charity have to be? Hopefully not very, but that's something that you're going to want to understand in discussion with the donor, in discussion with the company's attorneys, and in discussion perhaps with the company's executives. Taking a majority ownership position is challenging. Are you as the charity now responsible for the business's tax filings? Probably. What about legal and regulatory filings? Probably those too. That's why a lot of charities, even some very large national DAFs, will not consider majority ownership in any kind of business. And that's not to say that even a minority position couldn't still have important and material voice when it comes to the outcome of certain votes, because if you, and we ran into this year, 249% owners, but we as the charity received 2%. So if each of the other owners is opposed, now we as the 2% owner have the controlling vote. So you, even as a minority shareholder, can still have a material outcome on votes when it comes to voting stock. Now, not every donation of business interest is going to be voting stock. That's something you'll want to explore during the due diligence phase. And you as the charity will want to have a conversation about, when it comes time to vote, how are you even going to approach that? Some charities will just abstain from all votes. Others will go back to the donor and say, you as the donor can't control our vote, you don't have a proxy, but you know more about the situation than we presumably do. What do you suggest or recommend? The donor in that situation is likely to have some very practically helpful advice about how you as the charity should vote your interest. It may be immaterial if we're talking about a large startup that has hundreds of shareholders and you as a charity have a very, very, very tiny stake. Your vote is not likely to matter. But you know, that's not a given, and that's something that you should explore and have a policy in place for, to understand, okay, when we're asked to vote, how are we going to approach that? Tax reporting, very different when it comes to business interests compared to real estate. This is mostly an issue for pass-through entities, LLCs, LPs, S-Corps. C-Corps, you as a charity should be getting a 1099, which is not going to carry any sort of taxable income on it. But these pass-throughs are going to be sending you a K-1, and that could have taxable income. So that's something you'll want to consider, probably in consultation with your finance department and probably your CPAs as well. How many K-1s are you already getting? Is this going to be the only one you get? Are you already filing a 990T? Are you ready to file a 990T if you're not filing one? That's something your CPAs are definitely going to need to know about in advance. It's not as simple as just saying our CPAs will handle this at tax time. I wish it was. That would save Brian and I a lot of grief every September and October and November. But you know, that's something you need to keep in mind. These K1s, they could have UBIT on them. And you as the charity should, that's something you should look at during the due diligence period and when you're evaluating the donation. But you really can only speculate and guess so much based on what you're seeing when you're doing your due diligence. You really don't know for sure until you've got the K1 in hand. And oftentimes these K1s will have errors on them. The preparers just are not accustomed to dealing with charitable shareholders or members or partners. And so the most common one is that they don't list that the charity is actually an exempt org. Most of the filing software, I believe, has exempt org as a category, and that causes certain boxes on the K1 to populate or not populate, depending on whether it's been checked. If that's not checked, it may have some impact on whether the information you're seeing is accurate. So that's a common error. Also see the EIN being wrong, the name of the org being wrong, simple things, but those should be checked for when the K1 is received, and you really want to be going back to the issuer quickly, not waiting until 2 weeks before your tax filing deadline, or worse, 2 days before your tax filing deadline to get a K1 revised because the issuer did not list you, a charity, as an exempt org.
Well, and to tag onto that too, it creates a real domino issue because if you don't have one K1, sort of technically that's holding up the entire 990T return, which holds up the 990 return, which then means to be able to get it to the board soon enough to be able to have a full review file prior to the November 15th filing. The second thing is, if you're taking in any of these, you will never, full strong, probably close, ever be filing sort of timely without all of the extensions, because these K1s aren't even due until September anyway. So the point is that it can create some real knockdown effects. The other thing, not that you're looking for more things, is that when you're looking at the tax reporting, a lot of this is sort of deemed to be federal. Well, any of the state sourced income, which is typically reflected on the K1. And by the way, I think, and Ryan, correct me, I think we had 178 K1s last year. So we have a person like full-time right now, supposed to be next week, going through every K1 that we've received so far this year and then scrubbing it for all these errors that Ryan mentioned to make sure that that's done sort of in advance. So this is not theoretical. This is like she's supposed to be doing this next week. So now you got state source income. Well, what does that mean? Now, if you have certain over de minimis thresholds, you're actually supposed to be doing state tax return filings. And then it can confuse the state, because I got a call yesterday, not making this up. Ryan's already seen the email on or a text on Teams or the chat on Teams. And that is Florida, we had state source income in 2020. So we filed a state return. Then we did not have, I don't think, any state sourced income in 2021, because that was an asset that we brought in, had that reflected for 2020, sold, and then was granted out. So we likely didn't have any, but then in 2022, we definitely would have state source income. So the state is befuddled, going, whoa, whoa, you had it this year, you had it that year, you have to file anyway. I'm like, well, I don't know if we have to file because we had no state source income. Oh, no, you still have to file and say that you had zero with basically a memo as to why you didn't have any that year, but then you did again the next year. None of this is putting a man on the moon. It's a lot. I'm dealing with that yesterday, sort of dealing with that one particular state. And I think we file in roughly 14 or 15 states. And then that shifts from every single different year based on where the state sourced income is. It can be an Ohio corporation, or we'll say an LLC or S Corp, but then that's going to have a K1 reflecting a lot of activity in Arizona or North Carolina or wherever. And so that then pulls in through the flow through taxation, the charity into all those additional respective filings too. So again, just some additional knockdown things that you got to be aware of.
Yeah, and a lot of these tax considerations are driven not just during your holding period, while you as the charity are holding the business interest, but they're often triggered really on sale. Again, C Corp's not as much of an issue, but there are still some sale issues that C Corp owners should consider. But yeah, for charities, when it comes to tax items, often the big item is the capital gain triggered at sale if it's a flow-through entity, which I'll talk about here. But before you even get to that point, you have to agree to sell the interest. And unfortunately, with business interests, unlike with real estate, charity is usually not in a strong position to negotiate terms. And that's because the charity, as mentioned, has typically a very small ownership position. The problem is that usually the terms are, at least acceptable to the charity because everyone who's selling wants to get the most money they possibly can, and they don't want to have a bunch of contingencies tied to that. So everyone is pretty much aligned there. But where the problem really comes up for the charity are the representations and warranties that the selling shareholders all have to make. That may be fine for the shareholders who are actively involved in the business and they know what they're representing is true, but you as the charity don't. You probably don't know anything about how the business is actually operated. And if there are representations that go to specific risks associated with the business, environmental risks, think if it's an oil and gas producer, or privacy law issues, if it is, say, a healthcare company that's dealing with HIPAA regulations, you as the charity, when you're selling, are going to be asked to make those representations. How comfortable are you going to be agreeing to those representations? Because you're saying legally that those things are true when you don't know that they are. And if it turns out they're not true, the buyer or potentially a third party is going to be going back to each of the selling shareholders and asking for some kind of compensation. This is a potential liability at its core. So the reps and warranties can be a real problem when it comes time to sell a business interest. You should consider a few different options there to kind of solve or mitigate that risk. First, sometimes it is possible to have the charitable shareholder carved out of those reps and warranties, have the donor stand in the charity's shoes to the extent of any possible liability there. Another one that is more and more common is rep and warranty insurance. Sellers usually all like that, charity or individual or for-profit business, doesn't really matter. It protects all of the sellers. You could consider some kind of escrow again for the rep and warranty period, which normally lasts 2 or 3 years. So that's a bit of a long time. That's normally not ideal. And finally, you could consider a side letter with the donor where the donor agrees to indemnify you for any claims against reps and warranties. So that's something that's really important that is baked into the purchase agreement. But say all of that is sorted, you still have the question of how you're getting paid. Typically, you do not get 100% of cash consideration at the time of closing, unlike with real estate. There is almost always an escrow, even if it is just a 60 or 90-day escrow to true up the cash that was on the company's books up through the date of closing. There's still an escrow for that. That's usually quite small. There are often other escrows to resolve things like outstanding liabilities, which would again go to reps and warranties. So those escrows can be outstanding for quite a while. That's not the worst thing in the world. It's not that complicated. It just means you're going to get some more money later. But the other non-cash sale proceeds here can be more complicated and not ideal. An earnout is okay. It operates like an escrow in that it probably means cash payment sometime in the future, but usually those are at least a year removed, oftentimes 2 or 3 years removed. You're just going to receive more cash. It's going to be based on the financial performance of the company, all defined in the terms of the purchase agreement. But you as the charity are not going to have much control over when and how much gets paid out. So that's an earnout. Rolled equity is really not ideal because you're trading the private business interest, which you received, for some more equity, which in most cases is still private. Sometimes you will be lucky enough to receive rolled equity that is public stock, which you can handle just selling as you would a donation of public stock. But oftentimes what you're doing is just trading one private business interest for another, and that's not great. You've kind of restarted this whole process with new stock. And then finally, a note that usually happens in an employee purchase. So whether that's an employee stock ownership plan or ESOP, or it's just a key employee buying into the business, they rarely have the capital needed, which means they need the sellers to extend them credit. And that means you, the charity, are taking back a note from this employee buyer. And that's going to last for probably years. If you are very lucky, the buyer, the employee, will refinance and you will get cash and you will be off the hook. But I wouldn't count on that. And so the note means that your involvement in this donation could stretch on for years to come. I mean, sometimes those notes have a 10-year term. We just wrapped one up. One of the first donations I worked on with Brian, that donation closed in early 2017. And so here we are 6 years later, and the ESOP just made the last payment. So, you know, that can really stretch out the donation. But even assuming that you get all cash, now we're still thinking about UBIT. C Corps, again, this is not a concern, but LLCs, partnerships, S Corps, you can see this. With LLCs and partnerships, it is most often triggered because there is debt inside the partnership. With S Corps, it is guaranteed to be in the mix because charities are fully taxable to the extent of S Corp holdings. S Corp sales and donations generally are very complex. We have a whole webinar on the subject, so I won't go into much depth here. One thing I will note is that with S Corps, it is very common to see what's called an F reorg at the time of sale or shortly before, more technically. That means that the S Corp is now doing a tax-free restructuring whereby the sale of the business is now an asset sale. Buyers like that because they get a step up in basis. But the problem is, and this goes to the next bullet point, an asset sale will also extend the timeline for the donation. A stock sale is very simple. You sell the stock, you incur potentially a capital gain if it's that kind of business interest, pass through or an S Corp, and then you move on. You don't own anything anymore. If it's an asset sale, well, you still own that stock. It's just that the business sold all its assets and received cash in return. So now it's a holding company that has a bunch of cash. That may be great. Everyone may get the cash in very short order, but you still have that stock. What are you going to do with it? Is the company going to wind down? Are you as the charity going to be bought out? And if you're going to be bought out, is that potentially an excess benefit transaction? Are you being bought out by the donor or an entity the donor controls? That's potentially a real problem. You'll want to be careful thinking about whether you, the charity, are engaging in a transaction with a disqualified person, because the penalties for that are really nasty. And you'll want to consider, okay, do we need to have some kind of valuation to establish that the sale price is fair? Are we even comfortable doing that? Those asset sales can really complicate things, and it's often not something that donors are thinking about when they're planning the gift. They're just trying to get the donation done before the business sells. They're not thinking about an asset sale not really being the end of the line. So you, the charity, should flag that up front, but also keep an eye on it as the business gets closer to selling. Once you're a shareholder, see if you can inquire with the donor or the company or the deal counsel. Is this an asset sale? Because that's going to have some implications for you after closing, actually. Not at closing, but after. So much like with real estate and those kind of post-closing taxes, final bills, an asset sale means that the entire timeline is going to keep going after the business itself is sold.
Just a couple quick comments before you jump to international too. You talked about the note piece around the non-cash sale proceeds. So I think we've got, I don't know what it is, like 20, 25 different notes. whether those be from real estate sales or again from these business interest sales, primarily ESOP or an employee or other investors sort of buying in. And so just to really reiterate, like the tenant not paying rent, if they don't pay the note, we've had a number of these situations, then you've got to be pretty aggressive if there's remedy under the note for collateral. I would never, ever want to be sitting with an IRS agent saying, wait a minute, they stopped paying the note, but yet you could have foreclosed on the note against other collateral, and you chose not to do that. Tell me why that was in the best interest or, your fiduciary obligation as a board to do that. That would not be an enjoyable conversation. The flip side of that is, literally nobody can pronounce Decami, our foundation. Nobody can spell it. Nobody knows who we are. So we can be, I don't want to say aggressive, but we'll say assertive, where if you're a university, many of whom are on the call today, and you've got, which we had a situation one time where the very large university booster sold the business, actually sold to his son. Son was in 2009. Things were not going out well. The son stops making the payment on the note to the university. What do? Do they sue the big university's booster's son for all the PR and negative implications? Or do you say, well, I guess we're just not getting paid on the note until whenever? So be very careful. Next thing, very quickly, the non-cash sale proceeds as well. We have had specific situations where we were not sort of party to the discussions about the chopping up or allocation of how that looks. So in some cases, the donors would say, oh, we're going to take the cash, or donors or other owners. And well, the charity will just be happy for whatever they get. So we'll just give them, frankly, the junky stuff. That does not work. So you have to be what's called sort of pari passu, which is basically equal footing for whatever the class of the stock is or the position that we have. Ryan's also had a number of situations where the donors sort of put us in a preferred situation where they want to cash us out and then they sort of take the other assets that are perhaps more illiquid. So you just want to be real careful. A, is the earnout correct? Is the settlement allocation correct? And are we in any way being sort of minimized relative to our position as a charity? So just to make those key points. So it's not as straightforward as it otherwise can seem. So I think you're talking about international stuff now.
Yeah, and we've got a few minutes here. So I think we're maybe a minute or two ahead of where we were on Tuesday. So that's great. International assets. So all of these things that we've discussed for real estate and business interests still apply to international assets, but there are a special set of considerations there. Practical items, very obvious. Typically, these assets are located much farther away, perhaps many time zones removed, and perhaps there's a language barrier as well. And that's why, and we talked about this with the situation that we have in Uganda, local boots on the ground can be essential. And for real estate, I would argue they really, really are. You might be able to manage dealing with, say, Australian stock because there's no language barrier. Generally, the legal system works about the same way. So, share transfer paperwork looks basically the same as it does for a US business. But if you're talking about real estate, you really need to have, I would say, not just a local realtor, but probably a local attorney as well. So that can be very, very essential. But even if it's something more conceptually simple, like just moving cash and documents when you're selling the property, whatever it is, that can actually be more complicated than you might guess. First, you're sending it a lot farther away, and it's going to take longer to get there. And then second, and this is very easy to overlook, SWIFT codes are needed for international wires. I got an email from one of my wife's family members earlier this year. He's involved with a small charity that uses a small community credit union, was expecting to get a cash donation from the UK, but his bank didn't have a SWIFT code. And the bank in the UK that was the sender needed a SWIFT code to send it. It's a small charity. This was a 5-figure gift. They needed the money. They were counting on the money, and they could not figure out how they were going to get it. That's a real problem. And in this case, this example, we're talking about a cash gift. None of these other complexities apply, but because it's cash gift from outside of the US, you still can get tripped up with that SWIFT code. So that's something to keep in mind. Finally, regulatory requirements, both abroad and US, more complicated for international assets. IRS reporting, I know of forms 8865 and 926. There may be others. Privacy regulations abroad can be very different. They can be much stricter, particularly GDPR in Europe, the newer or semi-new privacy regulations that they have over there. Anything that rises to the level of personal identifying information can be subject to those. That's something that is not really as much of a concern in the United States, but is a big concern for European regulators. And then a final comment, CFC and PFIC rules. You will want to be very careful about those when it comes to foreign business interests. CFC is controlled foreign corp. PFIC is passive foreign investment company. If the asset or the stock from overseas triggers one of those rules, that can mean UBIT for charities. The good thing is those rules apply to all US shareholders. And so you can ask, maybe not the donor specifically, but the donor's tax advisor or someone in the finance accounting department at the company if it is a CFC or PFIC for US tax purposes, and find out if those rules are going to apply. If they do, that's something you would want to consult with your tax advisors on really as soon as possible. So I think that gets us just a minute over here.
I think great job overall. And if you just go to the webinar slide, just so people can see. So you'll get the email out next week, but these are all the past webinars we've had. You'll see actually a couple of these. There were a number of questions about S Corps. You'll see some S Corp stuff in there. I think there were a question or two about mortgaged real estate as well in the Q&A that I sort of answered as well. But these are all the ones that we've done. This actually, we did a bunch in 2020 that I couldn't even jam on the slide. So all these are free. You can see their CharitableSolutionsLLC.com webinars. This will be posted next week. And again, thank everybody for your time. I hope this has been helpful. Main thing is it's still pop the champagne, but maybe pop it twice. So you do the champagne when you get the gift, and then maybe champagne when you get the cash from the gift. So, and it might take 6 years, as Ryan mentioned as well. But hope this is helpful. Good luck with your clients and your donors, and we'll see you next month. Thanks, guys. Have a great weekend. Long weekend.
Thank you all.